Welcome to the Broken Pie Chart Podcast, episode 235. I'm your host, Eric Moore, and with me back on the program is CEO of ZEGA Financial, Jay Pestrichelli. Jay, welcome back.
Thank you, Derek. Episode 235. Hey, every time we do one, the number goes up. Is there a correlation there?
I think so. I think if you ran a regression with, every time we do one, the episode number goes up. I think we're on to something there, Jay.
It's like a beta of one, for those of you that want to know what beta is. Yeah, that's good. That's good stuff. I'm glad to be back.
Yeah, I figured you'd be out in Wyoming talking to our friend Jay Powell, but alas, you were in Florida. Mr. Powell had some things to say today, and the market first went down. Well, it went up, then it went down, then it went back up. But the headline here is basically, I don't think he said anything that was different than anything he's been saying before. Like, oh, inflation's still higher than we'd like. We're ready to act if need be. You know, we're going to finish the job. That was how he finished the speech today up in Jackson Hole, Wyoming, before he probably went horseback riding or whatever he did up there. Look,
I think to me, when the clips of it that I saw, because it was a busy trading day for us here at ZEGA, the clips of it that I saw, their target is still 2%, right? I think we've heard some analysts and other gurus on the street talk about, well, maybe they're just going to accept a 2.5 or a 3. They still want 2% inflation, right? And I think everybody agrees that, getting from 3 to 2 will be a lot harder from when we went from 10 to 5. So, I was surprised with the market reaction today, which was generally positive. I would say, right? We ended the day up. So that's, that was a little disconnect from, what I was hearing. But you're right. His message has always been the same. He hasn't come off his talking points. I think he has to stick with those. It's one of the tools in his, limited tool belt of either raising rates or talking about raising rates. So yeah, I mean, that's it. And I think the market had a little, the stock market, the equity market had a positive reaction. Bonds didn't seem to react too much. Did they go up today a little bit after maybe?
A little bit. I think the front end, I mean, the 2-year is over 2% now. So yeah, the back end went up. I mean, the back end's move was more over the last 2 weeks. But what did move, Jay, was the implied Fed funds futures for the end of the year. I think intraday.
That's the thing that I think the market heard, right? Which is, again, why I was surprised. Why don't you walk us through what the probabilities of the Fed fund futures look like?
Yeah, sure. And last week, I'll put a link in the show notes, of course, to last week's episode. I sort of went over, Jay, what these are and what they're not. I think sometimes they're misused. But we have the probability of the September meeting is 80.5% probability. Rates will stay just as they are, 5.25, 5.5. That's the current band. The news here, though, is that now the implied move in the Fed funds futures is saying, no, 0.25 point raise at the November meeting. Well, at least there's 46.7% chance of that. There's an 8.7% chance that there'll be a 50 basis point rise, which I don't know if anyone was even had that on the radar. So Jay, the TLDR on this is not expecting a raise in September, but Jay, another 0.25 point. We're going to do one more, Jay. That's new, I think.
That is absolutely new. Everybody kind of thought it was done after the last one. As I'm looking at this data, Derek, there is like you said, 80% chance that nothing changes on September 20th. There's a 20% chance that there is a change upward, right? So it's not zero. I mean, that was, I don't know.
So you're saying zero. There's a chance.
There's more than just that. We would call that, there's a 20 delta on that thing, actually.
Yeah.
That's what I
Yeah.
Look at me. I use beta and delta in the first 5 minutes.
I'm going to find a way to slip gamma in there at some point. But Jay, on these rates, to me, Powell has not said anything inconsistent the last 6 meetings. He's asked 6 ways till Sunday, if that's even the right phrase. So are you going to lower rates? He's like, we're not lowering. Remember that meeting? He's like, we're not lowering rates.
We're not lowering. Right.
Today he said, we're going to finish the job, and 2%, as you just pointed out. So like he's pretty consistent. And I think it's kind of like he's probably up there saying, are you not listening to what I'm saying? Like I haven't, why do you think we're going to 2.5 or 3% target? Why do you think we're lowering in next meeting? Like he said nothing like that. But somehow the market interprets the words that they want to hear, not what he's been hearing himself. But I don't know, Jay. I feel like too, 6 months ago, if what happened today, well, actually, let's talk about like a year ago. The market sold off pretty hard after he gave a speech at Jackson Hole. And that was his whatever it takes statement, right? Today, the market winds up. So I don't know. Maybe this isn't that big of a deal. I'm not sure if it is.
Well, I think, look, we're knocking on the door of 6% if we do get one more raise, right? I mean, we're talking about getting pretty close to that. And, like that's a number that I think at the beginning of the year, you and I even talked about, like, at 6 on the Fed funds, that's probably going to be pretty constrictive. Like it could, do the job of choking the economy. But so far, the economy's digesting this. I think he feels like he's been given the leeway to continue to raise rates because, the soft landing looks possible at this point. So yeah, I'm with you, Derek. I think the market is kind of reacting a little differently than it would have a few months ago. But touching 6 it feels like what originally would have been considered like damaging, significantly damaging. But somehow the market was still up. The stock market was up today. So there you go.
I didn't put a chart in there, Jay, but there's also the idea of what the real rate is, meaning adjusting for inflation, interest rates, the Fed funds rate minus the rate of inflation. Although I will say that's a little backward looking. So, if you say, well, inflation's 3.8% and Fed funds is 5.5%, then back of the napkin says you're what, 1.7 ish, right? Of a real rate of return. But I mean, yeah, I mean, if inflation is, let's say inflation stays the way it is, you have positive real rates now, which we didn't have for a lot of this time. After inflation, rates were below the rate of inflation. But I don't know. I mean, to me, when we think about what is not priced in, I don't think. Now, you and I have we're talked about. I talked about this last week in depth, but we talked about the episode before. I'll of course link to that, and it's the idea that higher for longer, but higher back end of the curve. Like if we don't get a recession, why would the Fed lower? Why wouldn't tens and 20s and 30s go up and steepen against the front end of the curve? And I don't think anyone's had that in their forecast. Right now, everyone says inflation's coming down. I don't know. I mean, what do you think, Jay? Like if oil starts to creep up, all right, that's a thing. And maybe it's wages. Maybe wages is a thing that Powell's really concerned about. I think he said something like that too, right?
I didn't hear him say anything like that, but obviously it's something they're always concerned about with wages kind of continuing to creep up. So two comments on that. So the first one, I'm going to do them backwards. So he talked about wages. I have seen that we're starting to see some relief in the amount of power that uh, potential employees have when it comes to pricing, meaning how much they can ask. So it looks like wages were kind of going up along with inflation. That seems to have slowed down. An article in the Wall Street Journal last week, earlier in this week, that basically said, hey, you don't have to pay up anymore. Like people are starting to look. I've heard stories about people, white collar, not blue collar, white collar workers, right? Professional services workers that are out there looking for jobs for 2-3 months and, putting their resumes out there and it's not getting picked up. And so we may start to see the higher end of if there's a higher end of the curve, the employment curve, right? That wages look like that's kind of peaked out a little bit in the short term. So that's an interesting point. So I haven't heard Powell say that, but I've seen, like I said, in the Wall Street Journal, that was an interesting article. The other thing that I heard this morning, which I thought was an interesting perspective, was, look, if Powell continues to be restrictive, he could arguably create a supply shortfall, right? Because the cost to produce goods ends up being too high, and the investment in making goods in advance of potential consumers buying them actually might cause another round of supply driven inflation. Have you heard this argument yet, Professor? Because I want you to comment on this one. I know it's out of left field for you, but have you thought about that? How we could actually have a supply problem again, which you and I both agree started this inflation cycle?
Yeah, I mean, there's really two ways to think about this. One is if your costs go up, it would add to prices. That's the easy step to make. Yeah, I mean, I guess you probably want to keep your inventory low, wouldn't you? If the
Right. If
cost of
you're worried about
carry,
the
yeah,
consumer, like, drying up on their spending, which by the way, it looks like the consumer spending is also starting to decline a little bit. If the consumer stops spending, you as a manufacturer, you'd manage your inventory down, and which means what? Then there could be the supply problem that, like I said, that started all this. That was the theory. And that's not normal, right? That is not the normal accepted kind of practice of rates and inflation. That's kind of the wrong way. But you and I have talked about how current rates are actually pushing up. I'm not going to say real estate costs. What do they call it?
no
The
rents they did.
domicile cost.
Of
Right,
course they
right,
did.
right. We've
Yeah.
talked. Yeah, that's what I'm saying. So, like, actually, the higher rates are causing inflation in parts of the economy, and definitely in the math of what calculates inflation. So, yeah, I mean, I think that would be an interesting and unforeseen consequence here of continuing to raise rates when not necessary, and then also add on to your point of why you said why would they possibly lower. Those are reasons why they might want to lower to stop this kind of unexpected supply driven inflation from getting a hold.
Yeah, no, that's fair enough. At the same time, I mean, the Atlanta Fed GDP now has Q3 5.75%. Now, a little, uh, let's sort of talk about this and break this down a little bit. We are halfway through Q3. And so the way this works is they take a good majority, but not all, of the metrics that go into measuring GDP. And every time you get a report, they update their model. And so, like, literally 2 weeks in, you might have one piece of data and it's like, oh, so this gets more and more accurate the closer you get to the end of the quarter, and actually to the release of the actual number, because quarterly data is still streaming in. We're July, August, September. Quarterly data is still streaming in second week of October. But 5.75% GDP that's kind of a big number. And you want to look at the trend. The trend right now is going higher for Q3, and that's where they can't see the chart, of course, our audience, but it's on the very far right of the graph there. And then you break down and you say, well, what's going on here? Of that 5.75%, what's the big driver? About 1.12% of that is inventories. So people, restocking inventories. Goods and services, 1.58%, 1.7%. Maybe Powell is looking at stuff like this being like, how do you have 5.7% GDP growth when, how do you have inflation pressures subsiding when people are spending this much? But all of these are positive, whether it's non-residential investment, residential investment. Net exports is interesting too. For years, our net exports were always negative. That's what you bring in minus what you ship out minus what you bring in to the country. But we're a net positive on oil now, which has only been the last 4 or 5 years. Like, that was always negative. So, Jay, this is just, I think it's, if you're looking at this, a 5.7, if we actually had 5.7% growth in Q3, I don't even know what the market would do with that, Jay.
Typically, that's a pretty bullish sign, right? To have that kind of growth. Like maybe just put it in perspective. In general, what's like the GDP for America? Like 2%?
On
Is that
average,
kind of
yeah,
fair?
over the last 10 years, it's probably 2%. Yeah.
Yeah, that's rate of increase, right? 2% increase per year. So, to potentially throw in a five there, yeah,
Yeah.
that's
Which
interesting.
of
And
course is
I think, look,
annualized. So you divide by 4, but yeah.
yeah, yeah. But my point to you is what I was going to say, and it's reinforcing your point, is it's the trend that's most important here, right? So we've been in a little bit of an uptrend on this data since looks like June. So July and August, the data that's coming in, that comes in all the time, has been kind of pushing this a little higher. Look, I think the GDP now has always been something that we watch, but while the magnitude of the number is usually up for question when it comes to accuracy, the trend has always been pretty good. Like if it's trending up, the real number probably is trending up too, right? No guarantees there, but that's generally what we've seen in the past. So GDP, if that holds true, is trending up in the quarter that we're in. Yeah.
All right, let me transition because you and I want to save not the best for last. Everything's awesome we're talking about, but I want to talk about the zero date to expiration options. Jay, I don't think I mentioned the response rate though yet. This government data, the Bureau of Labor Statistics, Census Bureau, all these different agencies, they go out and they calculate data, and a lot of this is based upon surveys. So in employment, the non-farm payrolls, you have the household survey, and that's where they call people at home. I don't know who gets those calls, but anyway, they're calling people and saying, "Hey, do you currently have a job? Okay, you don't, or you do? Great. You don't? Okay. Have you actually looked for work in the last X number of weeks? If you haven't, then you're actually not considered employed or unemployed. You're just gone out of the survey." And then you have the establishment survey. The establishment survey is where they actually call businesses. And when you look at the participation rate, so these surveys go out, and what's the percent of people who are actually responding? It's down to 40, just under 43%. And you look back, and from 2013 to 2016, 2017, it was above 60%. So Jay, is this that everything is so good at these businesses? They're like, I don't have time to answer these surveys, or everything is so bad, like, I don't even have time to answer these surveys. I mean, I don't know what to make of this.
Well, I don't know about yeah, like I've never got this call. You've said you've never got this call. I'm not sure what it is. I mean, look, it's does maybe they're doing a lot more calls and the same number of people are answering like this. I know that accuracy is better when you have a higher participation rate, but I don't know too much more data about this. It's definitely on the decline, but am I worried about it? I don't know. I so where is this data used, right? When it comes to the jobs number, right? This is kind of where this data
It's
starts
not
to.
non-farm payroll, your
Yeah.
payrolls, and yeah.
Yeah, so I mean that's a big number that comes out once a month, and of course we want that to be accurate. That's a market moving number, and it's a number that a lot of economists use to get a sense of what's going on, in business. But I don't know. I don't want to spend a ton of time on this one, except that yeah, it's going down. That may be interesting, but again, it's a percentage, so they could just be doing a lot more calls and getting the same number of responses. I don't know.
Do you remember it was probably 20 2012 20? I forget when it was actually. And what they found was there were some workers who were, supposed to be calling the households. And I guess there was, leave it to being a government operation, some pressure to basically get numbers, calls, and have some. I think they found out some people were just making it up. They were like, "Oh yeah, I called this many people." They're literally making up the numbers. I remember seeing a story about that. But another thing, this is a random thing. We'll spend 2 seconds on this. This is really actually I shouldn't I should I'm underselling this, Jay. This is really groundbreaking information here. the percent of stock ticker symbols that begin with each letter of the alphabet in the Russell 3000. Jay, did you know that the letter A, 10.1% of the ticker symbols start with A, but only 0.2% of stocks start with the letter Y? I don't know what to tell you on this, but they have, so it's every letter is this chart, and they have the
It
percent
feels
that
like
start.
we're really hurting for news when this is what researchers are doing. What's the percentage of stocks that begin with an A? That's Yeah, I'm not sure if that matters at all. What I'd like to know then is the performance of the tickers that begin with A.
Mm.
That's more important. Where's that real information? Because when you've got the dartboard up and you're trying to pick stocks, is it better to lean towards the top of the page or bottom? I don't know.
I don't know. Let's move on, though. I'll let somebody else do that work. I want to get to I think we'll spend some time on this. You and I in the past have, there's a lot of people talking about 0 day to expiration, or 0 DTE, which is shorthand for days to expiration options. And there's been a lot written about these are messing up the market, they're causing volatility. Goldman Sachs had come out, I forget which of the days it was, but I don't have their original thing, but from memory, it was, hey, the sell off was caused because there were 100,000 contracts traded of the 4440 put. And they were saying when people bought all those puts, then what does the other side have to do? Okay, so if you buy a put, that gives me the right to sell it at any price. So, Jay, if you were the market maker, you would have to sell stock to have a 0 delta hedge against the put. All right. Well, this is an article that came out. I think this is in Bloomberg. Bank of America disputes Goldman logic on 0 day option threat to stocks. I'm going to read two things, Jay, and then I'm going to get your thoughts on this, and we'll kind of go back and forth. They have an exhibit here, but it says despite the 4440 put having nearly 100,000 total contracts traded, customers were actually net sellers, not buyers, of only minus 1,000 contracts, roughly 100 times smaller than the total volume. They also go on to say, where's my thing here? As the S&P sold off, market maker hedging needs for the 4440 put were likely small in the direction of pushing markets up, not down. Exactly the opposite effect of what was claimed. Welty, and I don't have the person's first name, and his colleagues wrote in a note Tuesday, high frequency positioning data from the exchange suggests this is more of a good story than reality. All right, Jay, you and I have thoughts about this, so I'll let you start.
Yeah. All right. The first point is 0 DTE options have been around forever. There's always been a day of option expiration where the day you are in the option, that is the day they are going to expire. And those have always been the busiest days in the options market. We used to get all worked up over triple witching and quadruple witching, right? It's like, okay, it's going to be a lot of trading today in options and futures because this is the day of expiration. These, now that there are options expiring every day in particular tickers like, the S&P 500 index and the ETFs and the NDX, the NASDAQ 100 and the QQQs, all of those, a lot of those now have 1 day options. Every day they have option expirations. And it looks like, 40% of the volume on a daily basis is in the 0 DTE options. But this is not a surprise to us because it's always been the busiest day. Now, it just why is that, right? Maybe I do just a little bit about why investors like the 0 DTA aspect, right? It's the day where at the end of the day, you'll have the least amount of time decay. Probably all of the time decay is over on expiration day at the close. And so you can take a more directional bet, or you could earn the fastest acceleration of time decay or the fastest acceleration of earning premium in those scenarios. And so I have always been a believer that the current phenomenon and I'll say headlines that zero DTE options are getting is nothing new, except it's good for the options market because it brings more volume, right? If market makers can't handle the volume on a middle of the August, a day on the middle in the middle of August, right? Because there was 100,000 contracts traded in SPX. That feels to me like it's their own problem. It should not be a problem at all. And if the market moves one day, suddenly it's probably because there's just low volume in the market. So I was always in disagreement with the Goldman Sachs article that they put out last week, and I'm glad to see Bank of America called them on that. So I'm happy to see that someone's got a little rationale or using a little rational thought when it comes to zero DTEs.
I think what Goldman's point, what they were trying to say is there was I remember the day that it happened. I can't remember the exact date. There was a pretty sharp move. It was really late in the day, and you had people buying very cheap options that had a lower probability, a lower delta. But as the market comes down, those all of a sudden go from, I'm making this up, Jay, but let's say that they went from $1 to $10 or something like that, which means they're getting either close to the money or in the money, and the deltas start to rise on there. And so the market maker who's got those on the books and is hedged, all of a sudden has this delta that starts to come up there. Now, that's what their argument was. Bank of America, of course, is saying, well, there's buyers and sellers, and the volume doesn't necessarily have to be just buyers of puts. They could be sellers of puts too. So I think that's what Goldman was going to say. The other argument I think that was made by Goldman, and I wish I had the piece, Jay, I don't have it, was they were trying to make the inference that the market couldn't handle that level of short-term zero-date DTE options. It was too much. It created too much volatility. It couldn't take it. And I sort of dispute that as well. The market's massive. And I don't know. I found it hard to believe that this little number of contracts would have all of a sudden caused a major problem. And I don't know if you felt that way too. It didn't make sense to me.
Nope, didn't make sense. Seemed like an excuse. Yeah, you're right. The market dropped pretty quickly, and I think it dropped like 0.5% in a few minutes, right? And that was blamed on at least Goldman cited the zero DTE options for the cause of that. I disagreed. And I still disagree. So I'm glad to see this. I do think that there's a lot of value and utility for zero days till expiration options. I mean that we like them. We trade them, in some of our strategies, whether you're going long or short. I mean, it's one of those things that it gives you a lot less. What am I going to say? You got a lot less impact from things like implied volatility. You got a lot less impact from things like interest rates. Like the shorter the time period, the option you're trading, you get you really can focus in on things like time decay or delta directional movement. So yeah, it allows people to be a little more direct and exact in the way that they're investing with options. Overall, I think it's a good thing that we have these. It helps overall. I think it helps with liquidity. The infrastructure of the market should definitely be able to support this. I mean, we're only talking about what 400 million of net notional on this. The net selling of the net seller of those puts. That's really not a lot of volume for our markets.
Don't you think too that, a lot of times large institutions used to hedge with futures? And we know market makers also can hedge with futures as well. Don't you think these are actually interesting vehicles to use as opposed to futures? I mean, because you're right, you don't have the cost. There's really no cost to carry. You have not that much in time value that's left. There's some. There's a volatility in the options, a volatility premium in there. But this is kind of an interesting hedging vehicle that maybe otherwise they'd use futures. which, by the way, if you sold futures to hedge, or but the market makers would have to hedge anyway. So I don't know. To me, that maybe this is a replacement. Like, retail traders aren't pushing massive. The people who are trading GameStop are not pushing the market around doing zero DTE options, right?
Agreed. Definitely not.
Yeah.
So
let's just take a step back too, and when we talk about the effect of options, Jay, I'm going to play the retail customer. You play the market maker. I
oh yeah,
buy. So I buy. Let's say one XYZ, totally fictitious symbol, but we love it anyway. We love it. I buy one XYZ. Let's say the stock's trading at 100. I haven't looked at anything. I'm buying a 150 call option that expires in 30 days, and it's got a 10 delta. So I've just bought one call controlling 100 shares of stock, and it's got a 10 delta. All right, you market maker are selling me that call. What do you have to do to hedge?
Yeah, so now I've sold you that call, so I am short that call. So I have a bearish position on for selling you that call, and it has a 10 delta on it. So what that means is, in order for me to get neutral as the market maker, because I don't want to have market exposure as a market maker, I need to get long, I need to get bullish some stock to offset that risk. And the amount of stock that I buy is based on the amount that the option is going to change. So at a 10 delta, I would end up buying 10% of the number of shares. So if you bought one call, I would end up buying 10 shares. So now, me as the market maker, I'm short this 150 call, and I'm long 10 shares of XYZ stock. So I went out and bought some stock.
All right, let's reverse it. I'm the customer, and I decide to buy a 30 delta put. I guess we can just talk about, now that we've sort of explained parameters, but let's just say I buy a put, it's got a 30 delta. What do you got to do then, Mr. Market Maker?
All right. So since I sold you the put, which means now I'm bullish, I have to get bearish. I would short 30 shares.
Easy enough. And let's say I sold that 30 delta put instead of buying it. Now what do you have to do?
Sorry. Yeah. So if you sold it, that means I'm the buyer of the put. You sold it to me. I bought it. And so since that's a bearish position, I'm going to go buy 30 shares of XYZ.
See how easy that is? It's not complicated, right? It's
let's take it one step further, because I think everybody always finds this a little interesting on the dynamics there. So now let's say right, let's use the 30 put example, right? You sold the put, the 30 delta put. You're short, I'm long the put, right? And which means
I know where you're going. We want to, let's say the stock goes down and it goes from 30 to 60. Yeah.
Oh, now the put's in the money. Gotcha. Yeah. So now we've gone in. So now what did I have to do along the way? Right. So, so now there's a greater chance now. So I have to increase my my position, right? So you're short the put, I'm long stock. I went from owning 30 shares to now owning 60 shares, right? So I change my holding based on the delta of that option. And you in that scenario, like, hey, there's now you have a chance of actually, you're in the money on that put, right? You have a chance of getting assigned. I mean, you could always have it when you're short. You always have a chance, but it's now much more likely that you get assigned when that put went to 60, because now that put is in the money. There is a point where I may do that to you. I may be the one to assign the stock because I want to stop, hedging, right? I want to, at one point, once I've got 100 shares on my books against your put, I may just decide to say, I'm done. Let's net out this position for me. That happens too.
I do like going, I feel like no one really explains this. So I like going into the granular detail. I think people like that. The other thing I'll say is that we're using one example of me doing one action, you as the market maker doing another. But in reality, there's buyers and sellers all over the place. There are people doing spreads. I might be selling the put. Somebody else might have bought the put for you, and that's sort of helping you hedge as well. So There's any number of things that happen there. And there's what's in your existing book. So what are all the positions? Which ones are? So it's kind of interesting. I think hopefully this helps.
I think that when I think about like what's the Reader's Digest version of this is that options market do have an impact on equity markets because of market makers getting neutral, right? So at the end of the day, as the day's going on, if they find that there's a lopsided amount of trades on one side, they will end up getting net long or net short of stock, and so it's a way that the tail can wag the dog of the equity markets for sure. And you see this sometimes. It creates a little bit of a phenomenon we call where like you'll peg to a certain strike because there are a lot of options at a certain strike, and the market makers have to continue to buy until that certain strike like that. There's definitely ways that the options market can impact the equities market. It's not always a passive participant, meaning what happens in the options market is not isolated from what goes on in the with the equity market. So they definitely have some impact on each other.
I do remember it was probably a year ago. It might be 2 years ago now. Probably was. I feel like time, since 2020, everything's sort of 1 year feels like 10 years. But there were people on Reddit forums and Wall Street Bets, I think was the one, where they were like, hey, I'm going to go out and buy a bunch of really like nickel options that are really far out of the money. And I'm going to force the market maker to buy shares. And this is going to cause the stock to go up. Do you remember that, Jay? When that was a big deal for a while?
Yeah. I mean, it's part of the thing that drove some of the short squeeze in 2021 on those, the AMC and GameStops of the world, right? So, yep, I do remember that conversation. I mean, I do think there are other things that went into that short squeeze. That's not exactly this, but yeah, there's sometimes the feeling like, oh, let me buy a bunch of those. Look, the stock actually has to go up, though, right? Remember, if you're you're a buyer of these options, the market maker is only going to do very very small amounts of trading, right? They're not going to when you're buying 5 delta, 4 delta, 3 delta options, there's going to be very little impact when it comes to that. Probably just the normal volume of the stock is going to offset most of what's going on there in the first place. But, people try to break the mechanics of the market. They kind of see that stuff coming. I think the market makers like Jane Street and Citadels of the world, they're pretty good at insulating themselves from that kind of risk.
Yeah, I agree. The one thing before we get to some recommendations here, I guess the only thing when you have this many 0-day, essentially you have an expiration every day, especially in things like the NDX and the SPX. I guess the one thing is those would have higher gamma. So delta is for every 1 point move in the underlying, how much will your options price change? Gamma just says for every 1 point move in the underlying, how much will your delta change? And on the final data expiration, the delta can move quicker without explaining really what gamma is, and the interrelation there.
I think you're just looking for an excuse to bring gamma into the podcast.
Maybe.
I mean, you could have gone along the lines of, the Hulk radiation is also gamma, right? That one, if you
That's
really
right.
need to read it. Right. So the rate of change of the rate of change is what gamma is. It's the second derivative, right? And you're right. Gamma, you can get gamma squeezed on the day of expiration. That's right. That's true. Delta can move very, very quickly. Yes.
Yep. All right, Jay. I think we should go to recommendations. I would. Well, actually, real quick, I have noticed that the VIX. So the rate of change, let's say on the VIX, has been a little wide of late. It's not like the VIX has gone crazy, but we were down in the 15s and up in the 17s. It's just an observation that I think we're sort of settling into this. The VIX is deciding like what is it? Where's it going to go? Like what's going to happen? But there's been some, yeah.
And so that's interesting. I also think that the volatility of the VIX meaning the implied volatility of the options on the VIX is starting to come down too. I think I saw like an 83 on the VVIX today, and that's approaching a really interesting level for us. Like you and I have talked about in the past, what happens when VVIX passes 80. I think that's anybody can do their own research on that. But yeah, it's interesting to see when volatility, when the so let's think about why somebody would buy, because generally VIX option is buying calls, right? It's usually a protective, contrarian trade. So people are buying options on the VIX. They're willing to pay more or less. So these days, it looks like they're willing to pay less for the potential volatility of the VIX. So it could be construed as a little bit of a, as a little bit of a bullish indicator, right? When when the VVIX comes down, it's not an index a lot of people are familiar with, but it measures the how expensive or speculative the options are in the VIX. So, and the VIX is volatility. So, like again, I just did a second derivative, didn't I? So, like
You
that's
did.
almost like the of volatility trading. Sorry, you can work it now. So, yeah, like look, the VIX we've talked about. We're probably in this regime of lower volatility. Started to peak its head above, in the 18 range, and I think today we're in the 15s. We did drop below 14 at one point this week, didn't we? I think we did.
Yeah, we changed about 15.68, I think, today. Um, I don't know if you saw this, but the SIBO, I believe this was the SIBO reported this, the VIX options volume is on pace to exceed 2017 record. So
Interesting. Well, do you remember what is most notable in your mind when you think of 2017 and the VIX?
I
Anything?
think it was very low and it didn't move.
It just didn't move. It was like the lowest, like one of the lowest years of measured volatility on record. It might be the lowest since the VIX was out. So that would be quite interesting if we continued down this trend and you had lower volatility but a lot of volume. That would be something, I think. But who knows? Like every year is its own beast, right? So I guess we'll see how it all ends up.
Yeah, I didn't do enough. Maybe next time we'll talk about that a little more. All right, Jay. I mentioned on the show last week I started Breaking Bad, and I'm undecided on it. I feel like it moves a little bit slow. I might have to finish it just to finish it. I don't know. I'm undecided on that. You've never
It's
started
like
Breaking
90.
Bad, right?
That's a real commitment, Breaking Bad, right? That's like 90
Yeah.
plus episodes, I think. I have tried to start it, I think, three times, and I haven't got past episode 3 or 4. And I know there are avid lovers of Breaking Bad out there. Like when I tell people I'm having trouble like getting it going, they're like, "What? That is the greatest thing I've ever seen." I've heard somebody compare it to, in my mind, some of the great shows like Sopranos and Game of Thrones, and I just don't see it. But look, I know obviously they made a lot of episodes. Obviously, people love it, and so I'm with you, Derek. I've had trouble, failure to launch into the obsession with Breaking Bad. I got you. I'm not pushing back. I agree. Sorry, I agree on that one.
All right. I'm going to give it some more time. I'll report back. But Jay, show came back and a person came back in the show, and this came out of nowhere. Like I was telling you off air that my wife was like, "Hey, did you know that Billions is coming back?" I said, "Really? It is?" And of course, she said, Axe, the main character who was not on the show last couple of years, is coming back. And I said, "Really?" So it's back, Jay, and I've watched, I guess, the first 2 episodes. What do you think so far?
Listen, I'm a fan of Billions. It could do no wrong in my mind. I almost feel like it's required viewing if you're going to be in the markets. I think they do such a great job with that show. I won't give anything away on it, but yeah, I'm happy so far. They've it's yeah, you've got a lot of. I think it's the final season, so they're going to bring kind of everybody back in at some point. They've already started bringing back some old themes here. It's good. I enjoyed the first two for sure.
I'm with you. I feel like it sort of to go downhill and jump the shark last, I don't know, maybe year, 2 years, but so far so good. I'm with you. I always laugh though, because they'll have some real market stuff, and I believe there are industry people who are friends of the creators of the show or the producers, and they consult. I always laugh, though. They have kind of an affable character as the compliance officer, and I don't know if you remember. I don't know if you remember the episode. Yeah, it's pretty funny.
Spiros is the worst. They make Spiros
Yeah,
the compliance officer the absolute worst. You're right.
so they come in one day, and he's got some really elaborate formula on the board, and they showed it. So I hit pause, and I was trying to figure out, like, what the heck was it? I think we talked about it. I was like, I think he's trying to do value at risk, but I don't think it's anything. Do you remember that one?
I do remember. And then at the end of that episode, they actually said your formula was wrong on that. Right? He was keeping track of all kind of the trade by trade. It was actually a great episode where the systems had all kind of gone down, and they were trying to track their position and what they were trading out of. And actually, it was even like pre-market. And I remember Wags on the phone yelling at somebody to take the trade, just yelling, take it. I don't care what you do with it. Put it in your grandmother's IRA. Just take this trade. Yes, I think that was the same episode. Yes, and this Spiros got the calculation wrong. Yes.
All right. Yeah, no, I encourage people, if you haven't watched it, it's 7 seasons now, so it's on Showtime.
There's a lot of good market stuff. Like there's great drama, right? There's good drama between all the characters, and it shows how, if you haven't seen it, how the quote unquote bad guy hedge fund and the good guy U.S. attorney, the Southern District
of New York. Yeah.
Yeah, like how similar they are, even though they're on the opposite sides of the law. So very, very well done. If you haven't watched Billions, you should definitely do it. If you're listening to this podcast, you obviously are interested in the market. You should watch Billions.
Yep, couldn't agree more. All right, 2 thumbs up. We agree on that one. I'll let everybody know on Breaking Bad. All right, Jay, that's it. I know you have to. I think we just got to call it. So we're recording this on a Friday, so I think we're good, Jay. We'll see everyone next week.